On behalf of the Nigerian Exchange Limited and Renaissance Capital, I have the singular privilege and honor of welcoming everyone to this very important event, the 2021 Market Recap and Outlook for 2022, hosted by Nigerian Exchange Limited in partnership with Renaissance Capital. Thank you for all the participants and panelists and special guests on the show this afternoon, 1 o'clock Nigerian time, wherever you're watching this online in Nigeria and around the world. We say thank you very much, everyone, for coming through and our participants as well. Now, let's get the presentation started. And this is very important to start off the new year. Of course, the Nigerian Exchange Limited is at the forefront of leading the Pan-African capital market and making sure that the exchange continues to run. It's a very major event for the Nigerian exchange coming through from last year when it becomes a fully demutualized exchange. So this is the first major briefing in the new year by the Nigerian Exchange Limited under the leadership of Temikpe Kuola, CFA, who is the Managing Director and CEO. Temikpe Kuola, thank you very much, our Chief Host for today's event. We appreciate your coming through here on the show. Let me also very quickly run you through our special guest who will be speaking on the program this afternoon. Ben Akabweze, I'm going to start with him. He's representing, of course, the Federal Republic of Nigeria, but in his capacity as the Director General in charge of the Budget Office at the Office of the Ministry of Finance, Budget and National Planning. Mr. Ben Akabweze, thank you very much. He's been a renowned banker, investment banker who spent many years in accounting and auditing, as well as banking, spending more than 2 decades. He's bringing his wealth of experience and a former Commissioner of Finance for the Economic and Planning for Lagos State, as well as a special advisor to the President on National Planning. Mr. Ben Akabweze, thank you very much for joining us today for the entire session, most importantly for the fire chat which we'll have with you on the program. Also joining me this afternoon and this particular webinar is Charlie Robertson. I call him the Chief Evangelist of Emerging Markets for Africa. Charles needs very little introduction. He's well known. He's an author. He's the Chief Economist and the head of capital market at Renaissance Capital. He's done a whole lot in Africa, in particular West Africa as well, when you talk about experience about how the market works. So he's the one who's going to talk seriously to us about the emerging markets and the opportunities in the Nigerian market. Charlie, it's good to see you once again. Samuel Sule is the head of the He's the CEO of the Nigerian Renaissance Capital. He's the one who fought for Renaissance Capital in Nigeria. Sule has years of experience in the capital markets across Africa and Europe as well. Before he joined Renaissance Capital in 2018, he's been part of the Nigerian market, including the country's sovereign Eurobond issuance. Thank you so much. Just for everyone to understand that Temikpe Kuola, the CEO at Nigerian Exchange, Australia was an alumni of Renaissance Capital. So this is a homecoming for all the big boys of the Renaissance Capital today. So we're going to, it's good to be their company. Thank you very much. So I'm going to, and of course we have Jude Chiemeka, who's the divisional head in charge of a trading business at Nigerian Exchange Limited. Thank you everyone for coming through. Let me just give you very quickly to save time. Time is money when it comes to the marketplace. Temikpe Kuola will give us a few words of welcome. Then we kick on to hear from not just Temi. Later on is going to recap the year for us. Charlie is going to give us a very bespoke presentation, while Sule and Ben will have a fireside chat on Nigeria's budget and finance. Let's kick the ground running. Temikpe Kuola, thank you very much for coming. You have the floor for a brief welcome address.
Thank you very much, Bosin. It's a delight to be here. Let me thank and welcome first and foremost all of our speakers this afternoon. It gives us great pleasure. It's a day that we have looked forward to at the exchange. The market has looked forward to as well. So I thank very much all of our participants, panelists, Dr. Akabweze, Charlie Robertson, Mr. Sule, and everybody who's been in the background in making today possible. Of course, for everybody who's tuned in this afternoon, we are delighted to have you. It's a very important occasion, I think, for capital markets. And I thought I'd just very quickly speak to you to what we're hoping to achieve by the time we're done in another maybe 90 minutes or so together. We hope that by the time we're done, you will have, first and foremost, a good understanding of how the markets performed last year. Mr. Kadri, if you can please go on mute. Thank you. So we hope that you'll have a very good understanding of the market performance last year. Bosin, please, if you can also go on mute. Thank you very much. Okay, so first and foremost, we'll look into performance last year, what drove our markets. But perhaps more importantly, we'll be looking to understand the Nigerian macroeconomic sort of environment, which is what the fireside chat will be looking to do, and why Mr. Kabweze is with us. We will then look to get very good, call it frontier markets, emerging markets, global view, where Mr. Charlie Robertson will speak to. And to round it all up, at the exchange side, I thought it was important for us to spend some time then walking you through how we're planning business this year, I'd call it maybe the medium term. I'd be speaking about plans for listing, for trading, for products, and a lot of the strategic initiatives that we will be pursuing at the exchange. So in the end, we hope that you would have an appreciation for our markets, for the country, for the sort of global macroeconomic environment, and hopefully there'll be time for questions and for answers. So without further ado, I want to thank you all very, very much. Lots of our esteemed market intermediaries, doyens are on. Many of our clients are on. Just everybody who's here, thank you very much for joining us. And I look forward to a very, very exciting time together. Thank you, Bosin.
Okay, thank you so much, Temi Kukola, the Managing Director and CEO of Nigerian Exchange Limited. Of course, we're getting charts from more than 300 or nearly 400 participants right now. Thank you everyone for joining this conversation put together by the Nigerian Exchange Limited. Remember, we're going to have a Q&A towards the end of the presentations and the fireside chat and the presentation by Temi Kukola a little bit later on. So look at the Q&A function button, put in your questions. If you want these questions specifically to any of our speakers, kindly indicate at the end or the beginning of your little question, make it short, straight to the point so that we can take as much as possible. Then, of course, if you're offering comment as well, please also indicate perhaps the name of your organization. That would be good in a Q&A. If you want to put in comments or just chat, you have the box there on the right side of your screen. You can continue to do that. So let's put all of this together as we put our mobile phones and all that on vibes and other silent modes so that it does not interfere with the technical side of things as we move on. Then, of course, if you're not speaking, kindly remember to click the mute on your icon at the bottom right of your system, wherever that is located as well. So let's just hit the ground running with the fireside chat between Ben Akabweze, who is the Director General of Nigeria's Budget Office, many years of experience in the public service in terms of economy and national planning, finance, accounting, banking, is bringing all of this to bear. He's also an investment banker, by the way, an accountant and an auditor. He's got everything under his belt. He is sitting together to have this fireside chat with Samuel Sule. Sule brings a whole lot to the table as well. As the head of Renaissance Capital in Nigeria, he spent years in banking. He's been part of Eurobond offerings. He's done a lot in Africa as well as in Europe. I'm going to allow Sule and Ben to square it off with this fireside chat, speaking to the growth drivers for 2022. What are the finance and budget perspectives? Gentlemen, you have 20 minutes. We're listening to you. We have the floor.
Thank you very much, Bosin, and again, thank you to all of the audience and to the DG Budget, Ben Akabweze. I think we'll start this off very, very quickly by jumping straight into it, and we'll start with essentially what happened over 2021 when we saw Nigeria recover from what would have been shutdowns over the COVID period and some of those supply chain disruptions. And since then, we've moved to positive GDP growth, albeit still somewhat anemic, some might argue. And 2022 has been set into stone with the budget as the guide for that. The budget office essentially is a budget function, and it's essentially to implement fiscal policies. And from that perspective, sir, it will be good to understand what are the expected drivers of domestic growth for 2022. You're on mute.
For 2022, we expect growth to be driven by a combination of, higher investment and, of course, expenditure. In terms of, expenditure, government has remained as, has maintained an expansive fiscal stance as much as it can, given the resource constraints that, we face. We have recently, we recently, I mean, it was last year, launched the Nigerian Development Plan 2021 to 2025, which has an investment, projected investment size of about 349 trillion, of which the private sector is expected, to chip in 300, trillion over the planned period. And so this, budget and the underlying fiscal policies, as encapsulated in the Finance Act and other policy pronouncements, is intended to spur this, private sector. Government is also signaling through the budget that an area where we need significant, private investment is infrastructure. So the budget makes provision for government to do its own bit with that, in that respect. And there are, government, policies and schemes like the road infrastructure tax, scheme that, seek to, basically encourage such investments. Government has made it clear it's open to look at PPP transactions. The 4 major international airports are up for concessioning. All of these are, avenues for bringing in the much required, private capital.
Thank you for that. And as we look through, and you did mention the National Development Plan, I think that's a very clear and concise document. But one of the factors that we've continued to see is a concerted government effort to evolve from a debt-fueled expenditure and investment towards a revenue-driven growth. Can you please comment on these factors?
Yeah, I mean, Agodia in 2016, when we looked at it, we saw that basically we just realized that we had a revenue problem. It's just one that we had to deal with. Okay. And so we began to develop what we call the Strategic Revenue Growth Initiative. We set ourselves an ambitious plan, in the Economic Recovery and Growth Plan 2017 to 2020 to go from a revenue to GDP ratio of under 8% then to 15% by the end of the plan, period. Of course, we were then hit with the oil price, shock that drove the economy into recession. And during recession, you take your feet off the pedal in terms of trying to drive revenue growth. And 2017, we met from recession and we were revving up again on that. And then 2020, COVID hit and set us back, somewhat. But the good news is that the trajectory in that regard is, positive. And what we have seen is from when you look at the 2015 budget, for instance, in the 2015 budget, oil revenue was 58% of FGN's projected revenue. If you look at the 2022 budget, oil revenue is 35%. So basically, as a matter of deliberate strategy, focusing on non-oil revenue. And when you look at the result that we achieved in 2021, we're very encouraged that, this is moving in the right direction. In 2021, companies' income tax came in at 15% above target. VAT came in at 69% above target. Customs, ED collections came in at 10% above target. In government, FGN's independent revenues, mostly, transfers from our government-owned enterprises came in at 18% above target. And what let us down in 2021 was the oil sector. And oil let us down principally for three reasons. So oil in 2021, despite oil prices significantly higher than our budget benchmark, we ended up with oil at 50%, oil revenues in 2021, 50% of target. Why was that? Number one, we made no provision for subsidy because in 2020, there was a pronouncement that subsidy was gone. Unfortunately, subsidies resurfaced. And with a combination of higher oil prices and a devaluing naira, it got to the point where it didn't seem feasible by the relevant authorities to continue to adjust the pump price of petrol. And so subsidy resurfaced. And the subsidy scheme operates as a deduction upfront from the gross oil and gas revenues before it even hits the federation account to be shared. And so we lost over $1 trillion in terms of the impact in 2021. Oil revenues came short by that much. The other reason oil revenues came short was production for most of 2021 came in below the 1.86 million barrels per day we had projected. And why was this? Again, three main reasons. Number one was in 2020, with COVID and the reduction in oil production activity that it engendered, many wells had been shut in, and we realized that getting those wells back into production is not as easy as flicking a light switch. And then you also had some security challenges, but also had the problem of pipeline integrity, the product pipelines taking refined products from the production fields to the export terminals. And then the security challenge, which also meant that the specter of theft of crude oil is still here with us. All of that combined to depress oil revenues, and that's what let us down in terms of our revenue projections for 2021.
Okay, and thanks for that. And you mentioned a key point that I'm sure many parties in the audience are willing to understand a bit more about. Many assumptions are made on the budgetary framework for 2022. Oil price is set at $62, production at 1.88. You shared some views around 2021. The exchange rate important for 410.15 to the dollar. What are the basis of these assumptions? And are there any expectations of variation that would impact growth? And then I think we can also juxtapose the fact that subsidy is still here. We're in an electioneering year, some would argue, and the NMPC sees that in the context of $3 trillion. It'd be good to get your perspectives around those and those assumptions.
Well, essentially, week before last, I think it's not news any longer, as government rolled back the plan to eliminate petrol subsidies midway into 2022. We had to go back to the drawing board. NMPC has presented us with a 3 trillion naira tab, for this. By mid last year, when we were working on the projections for 2022, the estimated cost, if the subsidy scheme was in place for the full year, was put at 885 billion naira. And because we then projected that it will go up by the middle of the year, in the 2022 fiscal framework, provision was made for only 443 billion naira. Now, NMPC says it's going to be 3 trillion naira. One may wonder, how did you go from 885 for full year to 3 trillion? Number one, mid last year when we ran the projections, the daily consumption, the daily petrol consumption number that was used was 60 million. Now NNPC has revised that up to 65 million based on what they say is current reality. Secondly, the crude oil price, our projections were projected that crude oil price will grow, which is why the benchmark price for 2022 was significantly higher than that of 2021. But we didn't see oil prices this as high as they are now. And what crude oil price is the biggest determinant of the price of the refined product. So that has gone higher than was projected. Exchange rate also is higher. The 2021 budget was predicated on 379 naira to the dollar exchange rate. 2022 is 410.15, and so get that out of because you were asking a question around the basis for that. The central bank basically determines what exchange rate we use.
That's noted and very clear.
Yes.
I think the next question that we'll try and focus on is around revenue and expenditure and what that gap between it is. So revenue is projected to be 10.74 trillion. And the reason why I always use the second decimal point is because you always do so also. Expenditure is 17.13 trillion, which basically leaves a deficit of 6.39 trillion to be funded. What's the policy thinking behind this? And I know there is a concerted effort to move towards revenue growth, but at this current time, the debt component of that, whether it be new debt or debt service, seems to be high. It'd be good to get your views and expectations as we move forward.
Well, first of all, it's just this thing about how we closed 2021. We closed 2021 with 6.1 trillion in revenues for the federal government and 12.9 trillion in expenditure. So we ended up with 6.8 trillion in deficit for 2021. So 2022, we have a 10.74 trillion naira projection for revenues, and because there are concerns about how possible is that, out of which oil revenues is about 3.5 trillion of that. Okay, so what are the drivers of the rest of it? We see sustained progress in non-oil non-oil revenues. Some of that growth, of course, is inflationary. Okay, some of it, like custom revenues, are also driven by just the mere fact that you had a 379 exchange rate applied in 2021 to your dollar revenues or dollar denominated revenues. Now you have 410, so you have an 8% growth in just on the basis of of that. But we have also when you look at the Finance Act 2021, okay, it seeks to introduce some new revenue lines, and it seeks, more importantly, to drive efficiency, the efficiency of collection. And so there's greater use of technology, and the Finance Act 2021 now empowers FIRS to actually then compel taxpayers to give them access to their systems so that they can make sure that people are paying the right level of taxes. It's not a secret that tax evasion is very, is very prevalent in our, environment. And so, what we're trying to do is claw, that back. The VAT rate was increased in 2020 from 5% to 7.5%. In that year, you saw an increase in VAT collections. But in 2021, without an increase in the rate, holding it at the 7.5%, just by driving collection efficiencies, the growth in VAT in 2021, in the year where you didn't increase the rate, was higher than the growth you achieved in 2020 when the rate was actually, moved up. So for us, driving up government revenue is simply something we have no choice about now. There's no, as I say, there's no, alternative. Cutting back on government expenditure at this point in time is not a viable option. A number of reasons. Number one is, it's not like we're spending too much as government. Truth be told, we're spending too little. Our public expenditure to GDP ratio is way down towards the bottom, even on the African continent. So we're not spending nearly enough in aggregate, on a per capita basis. So what we need to do on the expenditure side is focus on efficiency of spending. But hoping to lower the overall size of the government expenditure at this point in time is not possible. Secondly, growth is still tepid, as you would observe. And so government expenditure is one that you drive, you drive growth. That's why the US is, government spending programs, whether it's on social or whatever, it's no tomorrow. But so the option that we have, therefore, is to try and shore up revenues, where we have, about the lowest revenue to GDP ratio, globally. And so we see there, as you do so, the concerns around that, the real concern about our debt currently is the debt service to revenue ratio.
Sure.
That's what raises questions about sustainability regarding our debt. But when you fix that revenue issue, then you address what seems to be a debt issue, but which, as you've heard the Minister of Finance say severally, that what we have is a serious revenue issue, not a class, debt, sustainability, challenge.
Sure. I think we're running up to time now, but I will ask one last question. Otherwise, I'll be amiss. And I think you mentioned the new Finance Act 2021. It brings in an array of new taxes. I think given the audience here is mostly in the financial markets, some of those taxes have implications on securities, whether it be the equities market, where there's the introduction of capital gains tax, or the debt markets, where the presidential waiver has not been renewed. Thus, withholding tax is applicable to all returns. What is the view the government is taking with regards to rolling back the exemptions or these new taxes? We understand it's to build revenue, but there's also an argument to say that the markets have developed but still remain nascent. Thus, a gradual or perhaps a lower version of those taxes might be more optimal. It would be good to get your final view for the audience before we wrap up. Thank you.
Well, first of all, some of what you call new taxes are not really new. Some of it, what we've done really essentially is plug loopholes where, for leakage. For instance, the intention was never to exempt, profits from, share sales from taxation. It was always clear that if you invested, but people were gaming the system. And that's basically the loophole that has been plugged. It's not something new. And then the thing to keep in mind at all times is to compare, and that's what we have, a tax policy committee that is dominated by private sector people and tax practitioners. And at all times is to make sure that we have a competitive tax regime. So in terms of new taxes, what you might call new taxes in this will be something like the excise tax on high sugar content drinks. Even that is basically putting back something that was suspended several years ago. But again, in terms of incidents, there it's not just first, that's not just about growing revenues. It's about curtailing early enough the rising burden of non-communicable diseases that we're seeing in our public health system. The public health care system is severely challenged dealing with communicable diseases. Now we're seeing an increasing burden of non-communicable diseases like diabetes and whatever. And so that's part of what this is meant to deal with, to begin to basically, regulate Nigerians' consumption of such products that could be injurious to their health. But in terms of quantum, it says 10 naira per liter of those. The average can size for those drinks is 33 cl. So the impact on a can is 3 naira 30. The average price, even in the informal retail whatever for those, is at least 100 naira. So the price basically goes to 3 naira or whatever. We don't think that it's such a devastating move as, but the other point to make, and that's the point that the Customs Service has argued. There's no other country on this continent and beyond where there's no excise on those drinks. So what is so I think that as we look at it, the truth is we have traditionally not paid enough attention to taxation, and so we have to face up to the fact that we're going to have to do catch up. That's why we have the lowest tax to GDP ratio in the whole world.
That's noted. And I think that ends this session, gentlemen and ladies of the audience. Thank you again to DG Budget, Mr. Ben Akabueze, and back over to you, Boason.
Thank you so much, Samuel Sule, the CEO of Renaissance Capital Nigeria, and of course the Director General Budget Office of the Federal Republic of Nigeria. Thank you so much, Mr. Ben Akabueze. Please kindly stick around. There are a few questions, so I have just about only one question of my own. Out of your presentation, quite robust. When you look at the public service expenditure as a ratio of the GDP, I begin to ask myself where we're going to find the money. The Egyptian government spent roughly $400 billion over the last 6 years, 2016 to 2021, in terms of public expenditure. So where can Nigeria find $400 billion, for example, to do what President Al-Sisi is doing up there north of the continent? And we'll be able to really do a whole lot more faster so that we can raise our GDP per capita and all of that. We need to find a way to resolve some of these issues. A couple of questions are coming through the inbox. Thank you so much. Get a glass of water, Director General, and then we'll listen to Charles Robertson. Charles is back to the emerging markets evangelist, the head of macro strategy at Renaissance Capital and the chief economist. Charles has little introduction. Charles, the U.S. Central Bank, the Fed, is going to sneeze in the month of March, which is next month, and then we're all catching cold ahead of that. So, as outside the developed markets, where are we on emerging and frontier markets? What is on your playbook for us, and how does Nigeria fit into that? Having listened to where we're coming from on the fiscal side, you have the floor, Charles Robertson, the chief economist at Renaissance Capital. You have the floor for 20 minutes. Let's listen to you.
Boason, thank you so much for that fantastic introduction. And can I just start by offering my commiserations about the football? That being defeated by the Tunisians is just, the North African thing. As an Arsenal fan, I share your pain. So I've seen a lot of disappointment in recent years as well. If you'll excuse me, I'm going to go through a set of slides because that's my comfort blanket and it's the way I remember what I'm going to say. And hopefully some of them will help kind of explain more simply than just my words where we're at. So if we start just with COVID, because it's been an issue, where's Africa sitting in terms of growth? And here I've got Sub-Sahara in light green, and you're seeing the GDP shifts. And 2008, 9, 10, Sub-Sahara did really well, better than the world in 2009, almost everywhere. And again in 2020, which is when all the countries where all the regions are falling. You're seeing Sub-Sahara do better than almost everybody. The recovery is a bit slower because you weren't hit as badly in 2020, and that's good news. And I think that's connected to the fact that COVID itself didn't hit countries as badly in Sub-Sahara. And we kind of guessed this was going to be the case once we had that Chinese data back in, I think it's February 2020, that said it's really hits the elderly worse. And in the UK, something like 12% of all deaths in the 2020-2021 period over 2 years, 12% was because of COVID. But according to the official figures in Cote d'Ivoire, 0%. Nigeria is 0%. Congo is 0%. So it's COVID hit countries that were younger much less, and thankfully for the populations that's the case. And I'm showing that there's a good way of showing that is when we look at the median age. You can look at the average in two different ways, the mean or the median. In terms of the median age, the average age in Nigeria is 16 years old on the left-hand side. And that's a key reason why COVID didn't hit too badly. But I'm going to come back to this a bit later because it answers your question that you just asked about Egypt. How did Egypt get $400 billion to spend in the last few years? And I would argue it's because Egypt's an older country. It's saved more money as a result. And the oldest countries tend to have the highest savings. So we're going to come back to that issue because it's crucial for understanding some of the challenges in Nigeria. Right, 2 or 3 months ago, we put out a report called Sparkling Markets. Everything was looking great, but I said there's a couple of grenades that looked like they could go off. And the two grenades that were most obvious were the global inflation story and the China recession risk story. Now, the China recession risk is really, it's there. This is a graph of the bond, the Evergrande, the biggest real estate company in China. China, the second biggest economy in the world, but the economy that's produced more growth than any other for most of the last 15 years, China. And this is a huge part of that economy is real estate. And the price of that bond has collapsed from something like 85 cents on the dollar to now about 16 cents on the dollar. And this is pretty shocking because if Chinese real estate goes wrong, then Chinese demand for cement and for copper, for the wiring and the housing, all of that goes wrong as well. And the hit isn't, in my opinion, a real estate problem like we saw in America in 2007 and 8, which leads to a financial crisis. The risk here is that a real estate problem in China leads to a commodity hit. The good news is that while I'm sitting there and watching this happen, it looks like the Chinese authorities have this under sufficient control. It looks like this isn't impacting growth too badly. And even my fears a month or two ago that Omicron might suddenly sweep China, and I really did worry about this in December, so far has not been happening. They're getting 50 cases a day. I think we do that many in about a minute in the UK. So China's actually, despite this graph, looking good. So that recession risk, that concern for markets doesn't really seem to be there. The bigger problem is the inflation, the Fed hiking rates in March, and we're seeing this jumping up of US yields. That's the green line there. Quite significant shift up. And we've raised our forecast for where we think US 10-year treasuries are going to be. A couple of years ago, for 2 years now, we've been saying 0 to 2% for the next 10 years. But a month ago, 2 weeks ago, we said, okay, 0.5 to 2.5. And my worry is that we're going to see those yields heading higher. I'm still hoping that 2.5 is as bad as it gets, and maybe we don't even cross 2%. But we have seen an impact on Africa, and not just Africa. We've seen Eurobonds, the pricing of Eurobonds issued by Ghana in blue, if you can see that on the bottom of this chart, Egypt in white, Nigeria in green. These bonds getting hit prices going down. People don't want African debt or Pakistan's debt or Sri Lanka's debt. In fact, they don't want bonds as much as they did just a month or two ago. And that's certainly a destabilizing factor. But where's this inflation coming from? The inflation is coming from, in part, this resurgence in oil prices. And this is a graph looking back over the last, well, in fact, since 1970. And we're nowhere near the highs that we've seen before. But the pickup in oil prices is a big deal, obviously, for Nigeria. Now, just in terms of how much does it help Nigeria's exports? I did a comparison on this graph looking at Botswana, which is the gray line, and pointing out that Botswana makes about $2,000, sometimes $3,000 per person a year from diamond exports. They got a lot of diamonds, not very many people. A country like Nigeria, yes, it's got a fair amount of oil, but not when it's divided by over 200 million people. So to be as rich as Botswana, we'd need to see the oil price at $400 a barrel, not 88 as it is this morning, for Nigeria to be getting as much money from commodities. So we're obviously not going to expect to see that. And you've probably seen this chart I've presented a few times before, lots of times over the last 10 years, looking at oil exports per capita. And on the left-hand side, it's the Gulf countries selling 500 barrels per 1,000 people every day. And on the right-hand side, Nigeria sells 7. So I keep on pointing out that oil isn't going to make Nigeria rich, but nonetheless, when the oil price goes up, as much as it's gone up in the last few months, it's forcing us to change our forecasts in a more positive way for the country. So this was our forecast just a couple of months ago for Nigeria. We thought growth, top right-hand corner, in 2022 was going to be 2.8%. We thought inflation was going to be something like 12. We thought interest rates might have to go up. And we thought the currency was going to end the year, so the bottom right-hand corner, we thought it was going to end the year at 482 to the dollar. Considerably cheaper Naira with all of the challenges that we've heard about for the budget. But today, I can show you our new numbers, because we're a baseline assumption now is oil prices are going to average $80 this year and next. Now, I don't know if that's going to be true. I have yet to meet the oil genius who always calls the oil price right. But the $80 means that at least we're going to get growth of about 3%, we think, in Nigeria this year. And if it stays at $90 oil, because this is what this slightly complicated scenario table is showing you, we think we're getting growth of 4%. The currency, maybe 465 this year. And with oil at 90, possibly 450 this year. Interest rates coming down. And the most important of all, the current account going into a very healthy surplus. So dollars will be flowing into Nigeria from this current account surplus. So this is a big deal. On the currency itself, it's a constant source of, well, I was going to say confusion or risk of confusion, but actually sometimes it confuses even us. But we've got 2 different models for all currencies. And one is done by Yvonne Mahango, our Africa economist in Johannesburg. And her number for Nigeria says that fair value is about 470 to the dollar. We've got a much longer dated model in London for more countries, emerging markets as well. That says 565 is the right exchange rate for Nigeria, which is pretty close to where I think the parallel rate is this week. But of the 2 models right now, I wouldn't trust mine. I would trust Yvonne's, because Yvonne's is over a period since 2004 when oil's been over $80, which is where we are now. In fact, with oil at $90, I'd argue you should be a bit stronger than that 470. And that is what we're forecasting, something like 460, 450 for the end of this year. And arguably could be even a little bit stronger than that. So the currency story's changed a lot compared to just 3 months ago, 2 months ago, with oil at 60, which was more, fits better with my model of 565. So there's a big shift here on the currency side, which I think is important. Long run, we still think the currencies has to go weaker, because if inflation in Nigeria is much higher than in America, the currency has to move in the long run to capture that. So this is showing that in 2030, the Naira could be 1,000 to the dollar. But it all depends on what we see out of inflation in Nigeria. If we've got very low inflation, if inflation in Nigeria was 3% a year, every year, until 2030, in fact, the currency then could be 430 to the dollar in 10 years, 8 years, not 1,000. So it really does depend on what happens with policy in Nigeria. And this then gets people like me focusing on next year's elections. Now, we've all been through a number of elections in a number of countries in some cases. What do we know? Firstly, sometimes businesses get a little bit concerned about what's going to happen, and they might decide to delay investment plans. But on the other hand, we've got this higher oil price, and so we've got we've got the government doing its bit to support investment. So that's a mixed picture. Do I have to worry about election kind of risk? Certainly, foreigners will talk about this. And we've seen a lot of coups in West Africa recently. Is this the sort of thing we should worry about? Not according to our data. Our data says Nigeria is, surprisingly to some people, very secure democracy. 95% chance a year, which is way higher than most others in the region. What about policy? What happens next year? And the market, I think, is looking for market-friendly policies from 2023 and from the new president. What are the challenges? We've talked about them: high debt, low revenues. I'll come back to that. Hopefully, oil prices stay at the 80 we're looking for, or even go higher, in which case Nigeria is going to be definitely easier position. And then I'd just like to talk about 2 or 3 things which I would hope that a president can focus on, because I think they make the biggest difference in the long run, and will make Nigeria more successful. I mean, I'm just showing you a quick map here. I need to update it. This is trying to look at democracy in orange versus autocracy in purple. And you can see Nigeria sitting there very significant. I'd have to change the colors for quite a few countries after the events of recent months. And I'm going to show you a different map and explain, I think, why we've seen coups in some countries. This map is looking at adult literacy, the ability to speak, to read and write about 4 lines in any language. Lines like farming is hard work in any language. When over half of adults can't do that, you're colored gray on this map. Places like Mali had a coup last year. Guinea had a coup very recently. Burkina Faso is a little bit better. Their adult literacy is about 40 to 59%, so it's roughly half the population. But that's still not a great number. And we had a coup there too. And we nearly had a coup in Guinea-Bissau just earlier this week. When adult literacy is below 40% in grey, you get the civil war, instability of Somalia on the right-hand side. And this isn't a problem just for countries. It can also be a problem for regions or states. And we certainly see it in northern Nigeria. These education numbers are telling me that the insecurity issues that we see in some states, the root cause is to do with education. So it'd be lovely to see a president come in and try and make a real big difference on this, because what you're looking for is to get to the high literacy rates you see in southern Nigeria. Lagos is amazing on this. Morocco is 70 to 80% literacy. And when you've got it that high in light green, you can industrialize. Then your economy grows at 7-8% a year when everything else falls in line too. What else do you need to fall in line? You need electricity. The grey are the countries where there's not enough electricity to industrialize. And that's a problem for quite a number of countries in sub-Sahara. So it'd be great to have a president. Jonathan did in 2011, he promised power to the people. It would be great to see a president who was able to deliver on that promise. So the education numbers certainly key, the electricity numbers certainly key. And there's an underlying problem which I've been trying to wrestle with, is why is there a shortage of cash? Why do I hear that the companies say they can't get credit? And it's to do, oddly, unsurprisingly, surprisingly to me, to do with fertility rates. That when countries have low fertility, they have high savings. Countries like Morocco, actually South Africa, Tunisia, have a lot of savings. And countries where the fertility rate's high, where we have a lot of kids, very few savings. And that's Nigeria, Angola, Congo. And I show that by looking at the kind of the size of the banking system. And the banking system in Angola or Nigeria, deposits in the banking system is about 20% of GDP. In Bangladesh, it's about 60%. Now, Bangladesh is really interesting because Bangladesh was the same population size as Nigeria about 15 years ago. And now Nigeria is way bigger in population terms, but much less successful on the growth front than Bangladesh. And it's because Bangladesh has got money in its banking system and it's connected to this fertility issue. So banks in Mauritius or Morocco have loads of deposits because people have savings, because the fertility rate's low, and they can lend, and you get great infrastructure. Egypt, the numbers are better than Nigeria, as we heard 10 minutes ago. Nigeria, though, the banking system, it's about 20% of GDP. And it's very common among the high fertility countries to have that, but it just means the banks don't have all the cash that the country needs to invest. So it becomes very profitable to invest in the banks. Some of you probably own shares in some of the Nigerian banks because the return on equity could be very good. Because if you have any money at all, it makes you very, it means you do well. It's just most people haven't got as much access to cash as they'd like because it's expensive. It's expensive in high fertility countries. So countries like Angola and Egypt and Nigeria and Kenya, the cost of borrowing is high. It's because there isn't much cash around. Where's the cost of borrowing really low? Yes, it's in Asia, like China on the left-hand side here, but also Morocco and Mauritius. Now, the United Nations tells me that they're forecasting that this fertility rate which is what, 5.5, nearly 5 to 5.5 in Nigeria today, is still going to be over 3 kids per woman, even in 30 years' time. And that means the savings challenge is going to be the same in 20 or 30 years' time, slightly better, but not much. I was listening to a conference yesterday that Business Day organized in Lagos, and there was a guy there saying 40 years ago when he was studying at university, the challenges were the same in Nigeria then as they are now. And I don't want that to be the case. And hopefully a new president can make a difference. And you can make a difference. The biggest driver, it seems, of fertility rates is infant mortality. When there's a high infant mortality rate, people have a lot of kids. And Nigeria's up at the top right-hand corner of this, and you want to be heading towards the bottom left-hand corner. And this isn't just about spending money. So Nigeria's mortality rate for under fives is over 100 per 1,000 kids. Venezuela on the left-hand side, same wealth level as Nigeria, but it's more like 30 kids. Ghana is half the Nigerian level, but they're the same wealth level as Nigeria. So it doesn't feel like this is hugely expensive to resolve the problem. It's not just about money, it's about using that money well. So hopefully a government can make a big difference, because when do continents take off? Continents take off when the ratio of kids, which is blue on these two graphs, goes down. So Asia was all sorts of challenges in the 60s and the 70s, war, conflict, poverty. The ratio of kids starts to fall, the number of adults starts to pick up. And right now, over 2/3 of people in Asia are adults. And that's great because they're out working and so on. In across Africa, it's still roughly 50-50. So half the population can't work. Well, the kids can do a little bit of work, although trying to persuade my kids to even do the washing up is a challenge. So it depends how lucky you are. So what I'm showing you here then is turning that into growth numbers. And the figures along the bottom is what's the ratio of adults to kids. If it's about 1, as Nigeria is, about 1 to 1.2, then per capita GDP growth is about 1.5%, 1.4 to 1.7. But when you've got the ratio of adults being double the number of kids, like Asia's got, you're up there at 2, 2.5 along the bottom scale, then your per capita GDP growth starts to grow at 3, 4, 5%. Nigeria will take off, and in a huge way, with these increasingly better educated people when the fertility rate comes down. So this is a rough graph showing why emerging markets are so attractive. They've basically been looking good since the 90s on this in green, and they're going to continue to be good for decades. Nigeria hasn't yet had the full benefit. It isn't there yet to get the full benefit, but it's certainly something we hope a government does something about. Short term, though, I'm going to try and finish off in the next 2 or 3 minutes. Short term, what have we seen? We've seen firstly this rise in debt. Everybody's gone out and borrowed more dollar bonds because savings have been a little bit short at home. It's not turned into the export growth. It's really essential that when countries borrow dollars from abroad, they invest in something which will produce dollars for export, so you can repay the dollar debt. And in Asia, we see that, places like Vietnam. Across Africa, it's been just that the numbers are getting a bit more worrying. Nigeria is looking good on this, on the right-hand side. We're still far away from problems. It's why Nigerian Eurobond prices are higher than in Egypt or Ghana, say. But overall debt to revenues, to come back to this issue, that's a problem. That really is a problem, and we do need to see the revenues growth. DG is absolutely spot on, as I'm very pleased to see an official who understands the issue so well and is so focused on it. It's because Ghana, in the top on the left-hand side, is facing a problem on this, and you see that the Eurobond prices are telling you that as well. Ethiopia is defaulting; it's restructuring its debt. Zambia is defaulted, and the fourth in line on that chart on the left is Nigeria. So this is a challenge for the next president. I'm going to skip past this in the interest of keeping this short, but this incredibly complicated graph, is basically telling you there's a solution that a country can find if it's got a small banking system because it's currently got a high fertility rate. And that solution is to run a current account surplus. If you run a deficit, your interest rates are really high. And if your interest rates are really high, you don't grow very fast. You don't invest very much. And it becomes harder and harder to get the growth. But if you've got a current account surplus, the dollars are coming in. Interest rates can be even slightly negative, according to that table in the top right-hand side. So this is really helpful that the oil price now is going to give Nigeria a current account surplus because it's going to help on the interest rate side. And then when I bring this back to what does this mean for the stock market? Well, the stock market actually looks really quite interesting. On the left-hand side, you've got one of the cheapest markets. Pakistan's slightly cheaper. They've got debt problems too. Mauritius is actually pretty cheap, but the tourism hit, you can imagine. Jordan's got debt problems. Nigeria is looking one of the cheapest next markets on a PE ratio and with a great dividend yield. To be getting 8% in dividends in local currency it's attractive for investors. Foreign investors are still going to be concerned by the exchange rate obstacle of getting in and out. But if that gets better because of oil, they could come back and help support the market too. So that I'm going to end the slideshow and stop sharing. at this point. Did I even actually share? I don't know. Stop share. So I did share. Thank God. Overall, big picture is it's looking better for Nigeria now. Growth 3 to 4%. A currency that looks like it can sustain a considerably stronger rate than I feared 2 or 3 months ago when oil was at 60, 65. Yes, it means a bit of weakness from here, but we've got a market which is attractively priced, and I could understand why investors will choose. Local investors certainly would be choosing the equity market as one of the places to go. And long run, countries can't just rely on debt to find the investment for growth. Equity is by far the safer way for Nigeria to be raising money to support investment and growth. So I very much want to see the NGX be as successful as it hopes to be in the next few years, trying to boost its role and what it can do for Nigeria. So I will stop there. Thank you very much.
Thank you so much, Charlie. As expected, a very robust presentation. Thank you so much. You've got the whole presentation, and at some point during your presentation, many of our participants weren't sending in questions, they were sending in comments. And the questions, the most question is, how will they get those presentation slides that you shared? Because it goes to the underbelly, below the belt for 200 million Nigerians, and you hit the live wire. And folks begin to forget a little bit about fuel subsidy, begin to think more about the fertility risk that Nigeria currently faces. And I think that speaks to a whole lot about the economy and where we're going. Thank you so much, Charlie Robertson, Chief Economist and Head of Macro Strategy at Renaissance Capital. Thank you so much. Hang around for a few questions. I'm not sure there is much, but I've got a few in the box. Let's take a quick listen right now to the head of the Nigerian Exchange Limited, Temi Bukola, CFA, to bring us up to speed. Give us what you call a backward looking and a forward future looking for 2022 outlook for Nigerian Exchange Limited. Temi Bukola, you have the floor, please.
Thank you very much, Bosin. Thank you. And Charlie, let me thank you for what was a very wonderful presentation. It was very well received. I do also say thank you to Dr. Kabweze also and Mr. Sam Sule. The session has been extremely enjoyable so far. So thank you and welcome again, everybody. I will spend about 15 minutes tops, just very quickly, going through performance for our market last year. But a big part of the comments that I would make really around the, call it 2022 outlook, specifically, what should you be looking forward to from the exchange, from your exchange in this year, 2022? Let's go to the next slide, please. I think Charlie has done a very good job speaking about some of the global market overviews. What this chart shows you is the performance of the exchange, NGX, relative to a few other exchanges across the continent and more globally. Our performance was positive, about 6% on the ASI, which is the one big metric that people keep an eye out on. You can see what our performance there is versus, say, Japan or Egypt or Nairobi specifically. One of the things that you find that's common to many of those countries, and I think Charlie touched on this, was their approach to the pandemic. Many of these countries adopted more commercial paths, more sort of market-friendly paths to their approach to taking care of the pandemic. And what you see then is a positive feedback from that once the pandemic starts to taper off. Let's go to the next slide, please. Talking about 2021 performance, it's always very difficult to do that, without speaking to the demutualization exercise that the exchange went through. And I thought it was important to spend a minute or two just to get everybody abreast of that for those who missed that. It was a landmark moment for the exchange. It went through the demutualization. What used to be the Nigerian Stock Exchange is now the NGX Group, which is listed now on the exchange. And that entity came with 3 operating companies. You have the core exchange, NGX, which is the where all of the licenses of the exchange now reside. It's the operating exchange. That exercise also gave birth to a world-class regulation company, NGX Regulation. And the third company is the NGX Real Estate. But I think it's important to say that, you know, as we walked through 2021, a lot of the benefits of this structure started to become apparent. So for example, the core operating exchange is now able to act more commercially and is now more able to compete now that the regulation function is standalone, is completely ring-fenced with very strong governance. So what that does, it of course strengthens our markets as well. It improves confidence in our markets. For those who are familiar with the challenges that our markets faced years ago, a lot of it bordered around governance, around regulation of our market, around enforcement. And in this new environment, it's something that we have taken extremely seriously. Of course, last year as well, one of the things that we spoke about quite a lot was the derivatives product, which we think our market is ripe for, and which NGX has taken a lead on. We got approvals from the regulator on those. Can we go to the next slide, please? All right, just speaking again about performance, I spoke earlier how the ASI was about 6%, but I think the right picture starts to get exposed when you look closer at the performance of different indices. And so what you see here, for example, is that most of the indices except 3 were in the positive territory. The oil and gas index outperformed the most. And you can see the 3 indices there on the industrials, for example, where we saw performance in the red territory. Our market capitalization grew by just shy of 6% last year for a size of about 1.24 trillion naira. So this is the equity market capitalization now for 2021. The turnover, which is really just measured by the value of transactions, we saw that decline by 10% to 1 trillion naira. This was in line with global trends where you saw liquidity dry up across most financial markets as we got to the troughs of the COVID pandemic. Of course, 2021, it's very difficult to talk about the equities market and NGX without talking about the digital offering that we had on the MTN transaction. And I will speak to that in a little bit more detail when I get to a few other slides. Can we go to the next slide, please? Fixed income market performance. As you know, we have on our exchange, it's not just equities. We do list and trade fixed income as well. And that asset class also actually grew much stronger than the equity asset class did. So we saw market capitalization there go up by 12.8%. And we saw the turnover, even though we're coming from a very, very low base as far as the turnover and the amount of fixed income trading that happens on the exchange of these listed bonds. But we saw that turnover increase materially from this low base by 158%. 2 transactions that are worthy of note from 2021 was the Boa Cement listing of the bond. This was the largest ever corporate bond issuance in the history of the Nigerian capital markets. And then, of course, the listing of the free zone tolerance 10 billion naira bond. What was significant about that was the fact that not only is it within a free zone, it also is the longest dated corporate bond in the history of the Nigerian capital markets. Let's go to the next slide, please. And over here, we see just very quickly a snapshot of the ETF performance. What you will find here from this chart on the right is that, of course, 2020 was a standout year. In 2020, you saw a lot of trading through ETFs, the new gold ETF, as a way really for investors, particularly the foreign investors, to trade in and out of Nigeria. But away from that, if you try to normalize the ETF flows for 2021 versus the other years, you would actually see that what looks like a decline year on year is actually momentum when you look at a few other years. Away from that, of course, it's important to realize that the amount of trading actually and the number of new issuances, for example, also for that year was lower than other prior years. Next slide, please. Okay, and just speaking about 2021 before I spend the rest of the presentation around 2022, a few other things that stood out for us last year. Many of you are familiar with a lot of the events that we had. We had an inaugural capital markets conference. We looked through that event to just really raise the bar as far as just consciousness with stakeholders as to the value of the capital market for the government, for the private sector, for investors. We had an inaugural technology conference as well, which buttresses quite a lot of the work that we're looking to do within technology. But away from that, a few other things that we tried to focus on were things around product development, how we improve our customer experience. So we deepened, for example, a lot of the digital transformation efforts that the exchange had historically done. So things like our X Mobile, which was just a way to get closer to those investors who would consume things more through technology, for example. A few other things like securities lending, market making, initiatives that are long-standing. We did try to push the dial on some of these a little bit more. Let's go to the next slide, please. And I wanted to speak about the outlook for 2022, and I would spend, I think, the rest of the discussion really on this slide and the one after, and really is how is the exchange and the management of the exchange and the board of the exchange actually looking to position our institution? For us, I would answer that really by addressing 5 things. The first is what I call building on momentum. We created momentum on this digital journey that we've spoken about quite a bit. So if we looked at the transaction that I spoke to earlier, for the first time in the history of our capital markets, investors were able to get access to a primary issuance in the space of minutes from an electronic device, whether a phone or their computers, without a call to any broker, to any intermediary. And this really was a momentous moment for our market. So this transaction, it's obviously been cleared by the SEC, to whom we're very grateful, and grateful also to all of our intermediaries and stakeholders who worked on that transaction. But when I talk about momentum, one of the things that you'd see from the exchange then is how we deepen this initiative, what we could do for a primary market issuance. How do we work with all of our intermediaries, with the stakeholders, to deepen and integrate that a little bit more vertically across the value chain of the offerings that we have. So this year, you are going to be seeing whether it's digitized listings as an approach, or perhaps how we can digitize further all of the work that happens with the intermediaries with access to our markets. Why is this very important? It's important because if you look at the belly of the Nigerian demography, it's a very youthful population. The exchange today is currently represented by an older generation of people, and to bridge that gap has to be through technology. So a lot of our work will be around retail, around customer experience, around integration of our market, integrating into banks, into financial service players, into some of the digital banks, for example. The second thing, now you can please go to the next slide now, which is the final slide. The second thing that you should look out for this year is around the subject of listings and delistings. I think listings are fairly straightforward. We all love listings, and the exchange is doing quite a lot to increase listings in our market. We started this year, for example, with a very big listing that's added over 1 trillion naira to the market cap of the exchange on the equity side, which was the Boa Foods listing. We're confident that there are a few more listings that are in the pipeline for this year, 2022. And one of the things that we're looking to do with that is also to diversify the types of listings. So it was good, for example, to see a listing from the food and consumer sector. We'd be asking how we can diversify those listings into things like power, for example, things like agriculture, for example, and have a more representative GDP of Nigeria represented on the exchange. But the subject of delistings also needs to come to the table. that this year, the exchange management and the board will really be looking at the quality of companies that we have listed. As much as we want as many listings as we can have, sometimes it just might be the right thing to delist some companies voluntarily by the exchange. We do think, just to make sure the market is aware, that we're taking a very closer look at the corporates that we have. We want to increase the levels of governance, for example, because ultimately the confidence of investors in our platform will be dictated by that. And so for some companies that may not meet some of our listing requirements, or for whom their objectives may have changed, you might see some delistings from that standpoint. And the hope, of course, is that the more listings will outweigh the delistings for a stronger, healthier market. The third thing, which leaves me very, very excited, is the work that we'll be doing within technology. If we look today across our capital markets, and if you look globally across the continent, there are very few listings that happen, particularly in Nigeria. And we don't need to go into the reasons why. I think Charlie touched on that. But ultimately, if you look within the technology sector, you see a lot of capital raising happening there, and a lot of capital formation. Every other week, we wake up to news of a technology company that's done a capital raise and a capital round. And for us as the exchange, we're asking how our market and our platform can be the platform that people raise and form capital. And so we've been doing a lot of work as management with the board. I think more importantly also with the SEC, the apex regulator, extremely important that they've taken a very strong leadership step on this to ask ourselves how we can attract more technology listings to our exchange. We've taken a very close look at our rules, at our boards, and we find that there's a lot of work that we need to do. So for example, NGX this year is looking to launch a NASDAQ-style board that we will call the Technology Board. And the hope is that on this board, our rules are fit for purpose. Our rules are suited better to be attractive for technology companies, to be flexible enough for them to find capital formation on our exchange. We feel confident that this would attract capital into Nigeria, Nigerians in diaspora, foreign investors, and indeed local investors as well. And it would really help us to achieve this fundamental responsibility of trying to drive the economy by driving capital from places where it's a surplus to those sectors that need it. So this year, you would see a lot of activity and interactions with the tech ecosystem. It would help us drive listings. It would help us drive returns to shareholders. It would help us get closer also to this younger generation of Nigerians. Two other things that I would like to speak to is also the work that we'll be doing around the free zone companies. I spoke earlier about this bond that was raised, this $10 billion bond. But very quickly, you can see that for companies who are operating within free zones, which is a lot of companies that we're all aware of, I think the government of Nigeria has devoted significant resource and energy and time into a lot of those free zone companies. Many of them, in fact, they can't actually access a capital market on the equity side today just because they're in free zone companies. It's another subject that we're working very, very strongly with the SEC. They've taken very strong leadership steps there as well, and are throwing a lot of weight and support behind that. Let me speak to also what we're doing around partnerships. The exchange, you will find this year and going forward, will be very, very big on partnerships. This event, for example, demonstrates that partnerships with our intermediaries, partnerships with corporates. You will find from us partnerships with other capital market operators, for example, capital market intermediaries, partnerships with corporates, because we're convinced really that this is the only way that a lot of our strategic goals really can be achieved. Finally, let me speak to the work that we'll be doing around sustainability. What you find is that sustainability is not just the flavor of the month, it's the right thing to do. So across our exchange as an internal company ourselves, to the way we interact with corporates, to the way that we do business, you'd see a lot of focus on ESG, on sustainability, on green, how we really can drive economic growth through a lot of these. I think that I've spoken now for 16 minutes. It's probably a good time to hit pause so that we can have about 5-10 minutes for questions. Thank you very much.
Oh, thank you so much, Temi Pokola, CEO of Nigerian Exchange Limited. It's been a very robust presentation all the way from the Director General of the Budget Office, Ben Akabweze, Samuel Sule, of the CEO of Renaissance Capital Nigeria. Thank you so much. Charles Robertson, thank you very much for your presentation as well. And of course now, Temi Pokola for robust presentations, including that fire chat. I think we just want to close as quickly as possible. More of the requests are coming through to have Charles Robertson's presentation. He says going to put them all in a new book. I got the fastest billion, signed off on by you, autographed by you way back around 2014. Charles, I hope I'll get another autographed one this time around on the traveling economist. That would be a great one to put together, looking at the emerging markets and Frontier Africa is going to be another service you're doing to the African markets. Thank you so much, Charles Robertson, for those robust presentations. And Timmy, we appreciate the fact that you keep bringing us up to speed. The forward, future-looking part of your presentation is really, really great. Let's take a few questions and just to try and keep the time. With the advertised time, we have just about 10 minutes left. So I'm just going to check very quickly. Folks are asking for the recordings, asking for all of that, but I'm sure a few issues are going to be asked. Temi Pokola has some of engagements immediately. The Director General, Ben Akabweze, thank you so much for coming back. We really appreciate your points in your fireside chat with Sule. But we're going to take just a few of these questions. Let me give the first one to Timmy very quickly. Timmy, you still there? Okay, great. Thank you. Any plans for addressing issue of investors whose FGN bonds are listed in their CSCS account are not getting their coupon payments when due? That's from Olurotimi Olajide Aditolu.
Yes, indeed. Thank you very much, Mr. Olurotimi, for that question. It's really a question more for the CSCS. I know without speaking for the CSCS management that it's a subject that they continue to look into. So I think if you'll be kind enough, please let's take that as a to-do from us. To specifically address this issue or this subject around coupons and the detachment thereof into accounts for investors. Thank you.
Okay, so just a quick one for the Director General at the Debt Office, Ben Akabweze. You talked about debt to revenue ratio. This is from Olalere Babasola. It's a challenge, but the government claims that the debt to GDP is what matters. So what's your take on debt to GDP as an appropriate measure to watch?
Well, thank you. And I don't really know when it says government. I'm part of government, and I'm here saying we're concerned about debt service to GDP ratio, and we're doing something about it. So, I mean, what has happened is, I think a lot of people are trying to be dismissive about the debt to GDP ratio. It doesn't matter, but all of it matters. That you've got to put all of those together, looking at your debt sustainability measures, and all it's not an either-or situation. Okay, ultimately, of course, debt is serviced from cash flow, which comes from your revenues principally, and so we are dealing with the challenge where it exists.
Director General, you also touch on the can of soft drink, and I'm sure folks are going to come after you on that when it comes to the issue of this carbonated drink and what have you. So how do we resolve this issue? Folks are asking, you're trying to maintain that little thing, but again, how's it going to work out in terms of you want to balance the health situation of the populace, at the same time you put in more tax in their can of drinks?
Yeah, it's just the same way you want to balance, but you put in more tax on. Look, our alcohol is still the cheapest, even in the region, the West African region. The tax on alcohol, the excise on alcohol, the tobacco is still the cheapest. So truth be, those are things those are policy initiatives that are still in the works to look at those two. So even the excise we put on this drinks is the lowest. I mean, as of last year, 21 different African countries had excise, acts on even telecom airtime. We didn't. So look, I know that this is a very inconvenient conversation once it comes to, because we are all involved, we all have skin in the game. So everybody's pushing back. But the reality is there's no, you'll have to tell me what the alternative is. You don't want us to borrow, you don't want us to raise taxes. So tell me what else we should do.
Okay, so what about the capital market tax? Timi Kukola, the government's talking about the government talking about tax, and folks are talking about this capital gain tax. Timi, what's your take on that?
Thank you very much, Bosin. So yes, indeed, the finance bill did come out with a new tax-related implications. Of course, many people will be familiar also with the 10-year tax waiver that applied on bonds issued by corporates, for example, that also elapsed late last year and early this year. What I would say to this is just that, the capital market, I would say, ecosystem has come together. We're working with the relevant government agencies, working with our apex regulator, the SEC, really to try to make some arguments around some of these taxes, the benefits of them. I think the DG spoke just now, a bit of a challenging situation we find ourselves as a nation. We have this short-term need for cash and for capital. But there's, of course, the tension that creates with the need to balance that with longer-term goals and objectives. So I think all I would say on that subject, Bosin, is that at least as a capital market, there are parts of these, tax changes that we think strongly that perhaps from the lens of sort of longer-term approaches, maybe some things could be amended. And we've come together, we're working with the SEC and looking to speak to the relevant agencies. Thank you.
Oh, thank you so much. Charles Robertson, the only question that seemed to come your way has to do with the dual exchange rate for Nigeria. How would you advise the Nigerian authorities to proceed with an efficient market-based exchange rate?
Nigeria had that. And we did a piece in 2019 saying that was a good time, I think, for a convergence on FX rates. I think it's an easier thing for any government central bank to do when the balance of payments is looking healthy, as this oil price does. So perhaps we see that shift happening over even in the next 12 months. We've published on this, and it'll be up to the central bank to decide when it's best to do it.
Thank you, Charles. Tell me very quickly, I know you're short on time, but again, how would the exchange in its digital transformation and adoption provide trading and custodianship for digital assets? That's from Suleiman Gaber.
Thank you very much. It's a very good question. So digital assets, we are currently doing quite a lot around digital assets, around tokenization, for example. Under the leadership of the exchange over the past few years, there's been a lot of work done on this. So for example, an art exchange is something that had been considered and that we continue to give some work around fractionalization of assets and their ownership. But however, having said that, it's another subject area where we've looked at ourselves and believe that partnerships might be the way to go there, whether because of the core expertise needed or perhaps just the pace of that sector. So we're in talks with quite a few exchanges, quite a few parties who are today offering services like this and trying to see how we can sort of partner that into a lot of the work that we have continued to do. Thank you.
Okay, well, it looks like some more of the tech guys are going to be heading your way because they're asking questions about that you please give them very flexible and attractive listing fees and things like that and structure. So they are ready to come your way, but you still make some money. from those listings, by the way, and there are quite a whole lot of them. So you're going to make money in 2022, 2023 moving forward. Timmy, it's something to smile to. I know. I'm sure you're fortunately no questions went the way of Samuel Sule. So I'm going to give you just about 30 seconds or 1 minute before I ask Jude to give us the closing remarks. Very quickly, Samuel Sule, you want to say a few words in wrapping up?
No, thank you very much to the exchange for this. I think much guidance is needed for the markets as we move forward. It's an interesting year for all. Many expect it to shorten the year, and all hands being on deck and a formalized way of putting all hands on deck is much appreciated. So thanks again, and I'll hand over back to yourself.
Thank you so much, Samuel Sule, the CEO of Renaissance Capital Nigeria. Jude Chiemeka, Divisional Head Trading Resources at or Business at NGX Limited. Let me yield the floor to you to give us the vote of thanks to wrap up this highly energized presentation, workshop, training, summary, whatever it is, summit that everyone has had for the last 1.5 hours.
Thank you very much, Bosin. It's indeed a privilege for me to deliver the closing remarks and extend a vote of thanks at this year's NGX 2021 Market Recap and 2022 Outlook held in collaboration with Renaissance Capital. We acknowledge the impactful discourse engaged in today, and our applause goes to our distinguished guest, Mr. Ben Akabueze, the Director General Budget Office of the Federation, Charles Robinson, Global Chief Economist, Head of Macro Strategy, Renaissance Capital, and Samuel Sule, Chief Executive Officer, Renaissance Capital Nigeria, who honor this invitation and have contributed tremendously to this event. To the moderator for today's event, Mr. Bosin Omofaye, CEO and Executive Editor, Frontier Africa Report, we are grateful to you for delivering a truly insightful event and for your continued support for the exchange's activities. Our greatest gratitude goes to the audience who joined us across various online platforms and interacted by sharing their comments and asking insightful questions. All of those insights that we have gleaned today will be of little benefit without the local and international investors, capital market operators, and all our participants who have taken our time to join today's event. I will be remiss not to thank you for coming, and I do hope the session has been as enlightening for you as it has for me as well. I urge you all to renew your commitment to fostering and unlocking the diverse investment opportunities as highlighted in the Outlook projections for 2022. At NGX, we will continue to actively engage all our stakeholders, including government, policymakers, and capital market intermediaries on opportunities to develop the capital market, provide the thought leadership necessary to aid the ease of doing business in our nation. We'll invite our stakeholders to take advantage of our current product offerings and to anticipate in the very near future new products and technology-related solutions that will enhance the ease of access to our market and deepen capital market activities. This annual market recap and Outlook event is one of our stakeholder engagement initiatives, and we look forward to engaging you all, and indeed all of our stakeholders through events such as this throughout the course of the year. We look forward to the continued collaborative work globally with investors, financial institutions, and businesses towards developing and deepening capital market solutions. Till next time, thank you all for listening and continue to stay safe.
Thank you so much, Jude Chiemeka, Head of Divisional Head Trading Business at NGX. For all the participants who want some of the presentations, it will be shared by the Nigerian Exchange Limited team. They will get to you. For those who are registered, your email are in the box, so that they'll get back to you on those sharing of those. We will also share a bit of some of these presentations on Arise News later tonight from about 7 p.m. Nigerian time. You need to keep your eyes on Arise News, whether you're watching in Europe via Sky News or you're watching across Nigeria and Africa on DSTV channel 416. Keep that in mind. Will be tonight between 7 o'clock and 8 p.m. Nigerian time. You get a bit of all that as well. The presentation also by Charles Robertson. Keep that in mind, everyone. Again, we want to say thank you so much, Charles Robertson, the Chief Chief Economist and Head of Macro Strategy at Renaissance Capital. Thank you. We look forward to seeing you again. Samuel Sule, the CEO of Nigeria, Renaissance Capital Nigeria. Thank you very much for coming through. The Director General, the Budget Office. Thank you for your time, Mr. Ben Akabweze, and of course, our chief host for this particular event, Temi Pokuola, CFA, the Managing Director and CEO of Nigerian Exchange Limited. Have a great day, everyone. Thank you very much on behalf of NGX and Renaissance Capital. I'll see you next time. I am Bosin Lamofaye, and I'm signing out at this time. We appreciate your time. Thank you very much. That was a great presentation, my friend. That was huge. That's huge. We're going to be taking a bit of your presentation later tonight on television, if you don't mind.
Sure, but I really valued listening to the DG. I learned so much from the DG. I thought your hosting and your speed of presentation actually was was really good. It was very refreshing. It keeps it very high energy. It was. I'm really pleased you're on this.
Thank you, Charles. Thank you, everyone. Thank you, Jude. Jude, sorry, Charles. I'll share my email. I don't know if we can connect. How do I send that to you very quickly before
if you
I'll
do
put
it
in the chat room.
Hosts and panelists on the if you do that
Host
bottom right.
Yes, I'm going to put it there now.
That'd be very cool.
Okay, I just put it there now.
Okie dokie.
Alternatively.
Well, there is a way I think of doing it direct to one person, but I haven't quite worked out how to do that. Oh, there we go.
Yeah, it's okay. No, you got my email. You can send me your email directly via my email. So you could just copy my email down, the 2 emails I've sent, then you can send me your email as well.
I think we're still live on YouTube, but I'm signing off now. Thank you very much.
No. Yeah, I think the recording have stopped. Thank you so much, everyone. Thank you. Charles, I look forward to your email.
Pleasure.
It's coming.
Thank you. Thank you, Charles. Thank you, everyone. Maria, thank you, Clifford. Thank you, everyone. Have a great day.
It was good teamwork.